You're looking at your portfolio down 15% this year, watching the market whipsaw your savings, and you're wondering how some investors seem to win no matter what happens. You check the usual suspects, Buffett, Munger, but their moves feel too slow, too safe for the world we're living in. Here's what you're missing: the man with the most insane track record in modern finance isn't playing the same game as everyone else. I've spent years tracking what the smart money actually does, and Stanley Druckenmiller's numbers broke my brain. 30 years managing money. Zero, and I mean zero, losing years. Not even 2008. Not even the dot-com crash. While other legendary managers had their bad years, Druckenmiller averaged 30% annual returns without a single down year until he retired from managing outside money in 2010. The guy who taught George Soros everything about currency trading had cracked a code that most investors don't even know exists. But here's the thing nobody talks about: he's still actively managing his family office, and his recent moves reveal a pattern that's completely different from what you'd expect. Look at his current portfolio, and the first thing that'll shock you is how concentrated it is. His top position? NATERA, a genetic testing company, makes up 18% of his entire portfolio. Most financial advisors would have a heart attack seeing that kind of concentration in a single biotech stock. But Druckenmiller isn't most investors. When he finds a thesis he believes in, he doesn't sprinkle money around like he's seasoning a salad, he backs the truck up. His second biggest position, INSMED at 5%, is another biotech play focused on rare diseases. This isn't diversification for the sake of sleeping well at night. This is conviction investing at its most pure form. But the concentration isn't random. There's a method to this apparent madness that becomes clear when you see his third pattern. Taiwan Semiconductor sits at 5% of his holdings, and this isn't just another tech bet. Druckenmiller has always been obsessed with finding the companies that sit at the center of massive technological shifts. TSMC isn't just making chips, they're making the chips that power AI, autonomous vehicles, and every major tech breakthrough happening right now. He also holds ST Microelectronics at 2%, doubling down on the semiconductor thesis. But here's what's brilliant about this approach: instead of buying the flashy consumer brands everyone talks about, he's buying the companies that make those brands possible. It's like owning the gold mine instead of the jewelry store. The real kicker, though, is how he balances these concentrated bets with something most growth investors completely ignore. While everyone's focused on his biotech and tech plays, Druckenmiller quietly holds positions in Alcoa at 2% and YPF Sociedad Anónima at 4%. These aren't growth stories, these are inflation hedges disguised as value plays. Alcoa gives him aluminum exposure right as infrastructure spending ramps up globally. YPF is an Argentine oil company that benefits from energy price volatility. This is classic Druckenmiller. While the market's obsessing over one narrative, he's positioning for three different scenarios simultaneously. He's not just betting on growth, he's betting on growth, inflation, and geopolitical instability all at once. But the most surprising part of his strategy isn't what he's buying, it's how he's buying it. Here's where it gets really interesting: 4% in iShares ETFs and 4% in Invesco exchange-traded funds. Wait, what? The man famous for making massive concentrated bets is buying index funds? This isn't contradiction, this is genius. Those ETF positions aren't core holdings, they're tactical weapons. When Druckenmiller wants broad market exposure without picking individual names, or when he wants to hedge his concentrated bets, he uses ETFs like surgical tools. It's the difference between a painter using a fine brush for details and a roller for coverage. Most investors think you're either a stock picker or an index investor. Druckenmiller proves you can be both, strategically. And that brings us to the pattern that ties everything together. C Limited at 2% gives him exposure to Southeast Asian e-commerce and gaming, basically betting on the next billion internet users coming online. New Amsterdam Pharma at 2% is another biotech play, but focused on cardiovascular drugs. BBB Foods at 3% covers Brazilian consumer markets. See the pattern? While most US investors are obsessing over domestic plays, Druckenmiller is building a truly global portfolio that benefits from growth wherever it happens. He's not just diversified across sectors, he's diversified across economic systems, currencies, and demographic trends. This isn't about spreading risk thin. This is about capturing growth from every major trend happening simultaneously across the planet. Here's what makes all of this possible: Druckenmiller's famous lose small, win big philosophy. He's willing to take massive concentrated positions because he cuts losses faster than anyone in the game. When a thesis breaks, he's out. No emotional attachment, no averaging down, no hoping it comes back. This isn't about being right all the time, it's about being wrong cheaply and being right expensively. His 30-year track record isn't from picking perfect stocks. It's from perfect position sizing and perfect risk management. The concentration looks crazy until you realize he's got an exit strategy for every single position before he even buys it. Look, you don't need Druckenmiller's billions to apply these principles. Start with concentration over diversification in your highest conviction ideas. Add global exposure beyond just US markets. Use ETFs tactically, not just as set and forget holdings. And most importantly, get comfortable cutting losses fast so you can size your winners appropriately. The legendary track record isn't about picking perfect stocks, it's about perfect portfolio construction and risk management. Ready to start thinking like the pros? Head to nexusaicalls.com for our latest market analysis and specific opportunities we're tracking right now.